The financial year is coming to an end, and what a year it has been. No matter where you invested, you would have made good returns. Now, as of March 6th in FY24, Nifty 50 has gone up by around 31%, while Nifty Mid Cap 150 and Nifty Small Cap 250 have given 59% and 68% returns respectively. But where there are returns, there are taxes. Now, if you have booked profits, in most likelihood, you will have to pay a part of those profits as taxes. And even if you haven't booked your gains, whenever you do book your profits, you will have to part with some of those thanks to the taxes involved. So, is there a way to reduce or even eliminate those taxes, legally of course? Well, what if I told you the answer to that question is yes. You can actually reduce your tax to the point of paying zero. Yes, you heard it right, zero tax. Hello and welcome to ET Money's YouTube channel. Today, we will talk about two less known, less understood ways to save tax harvesting and tax loss harvesting. But do remember, you will have to do this before the FI ends. So do watch this video up to the end so that you can understand this strategies well. But before I start, here is some useful information. You are watching this video on our English channel. हमारा एक हिंदी चैनल भी है जहाँ पे ये सारी वीडियोस आप हिंदी में देख सकते हैं. And we have a channel meant for investing basics. It's called 5-Minute Finance. You can find the links of these channels in the description. Alright, let's begin with the first strategy, which is tax harvesting or tax gain harvesting. Before we go into tax harvesting, let's first look at the taxation rules for equity funds and stocks. So there are two major taxes involved, short-term capital gain tax and long-term capital gains tax. Their short forms STCG and LTCG are commonly used. Now, STCG is applicable if you sell your equity funds or stocks at a gain within 1 year of buying, and the current rate of STCG tax is 15% of the gains. On the other hand, LTCG tax is applicable if you sell your equity funds and stocks at a gain but after 1 year. The current rate of LTCG tax is 10% of the gains beyond 1 lakh. So gains up to 1 lakh are tax exempt. Now, until FY19, there was no tax on long-term capital gains from equity. But the Union Budget of FY19 changed it all. It reintroduced the LTCG tax on equity. Obviously, this didn't go well with the investor community. So as a small relief, an exemption of long-term gains up to 1 lakh rupees was provided. However, this exemption of 1 lakh rupees on long-term capital gains opened an opportunity for saving tax. And that's how the concept of tax harvesting came into being. Let's understand this with an example. Let's say you have invested 5 lakhs in an equity fund and you earn a CAGR of 12% and you hold it for 10 years. Now at the end of 10th year, the value of your corpus will be around 15.53 lakh. Now at this point, you sell the fund. Since you sold it after 1 year, it qualifies for the LTCG tax of 10% over the gains of 1 lakh. Now, your total gains are 15.53 lakh less the investment amount of 5 lakh. So about 10.53 lakh. Of these gains, there is no tax on 1 lakh. So 9.53 lakh are taxable. Now at 10% of these gains, the tax comes to about 95,000. No surprises up to this point, right? Well, now comes the tax harvesting into picture. Let's see how it can help you reduce the tax outgo. As we discussed, there is no tax on the gains up to 1 lakh rupees in a financial year. So let's assume a case where you invested 5 lakhs in an equity fund and as soon as you completed 1 year, you sell the fund. Then you put the proceeds back into the same fund. As another year is completed, you again sell the fund and invest the proceeds back into the fund. See the table on your screen now for the outcome. At the end of year 1, as 1 year has elapsed in the investment in the fund, you have gains of 60,000. When you sell the fund, those 60,000 gains are booked. However, since they are less than 1 lakh, there is no tax on them. Now, you reinvest the 5.6 lakh you got back into the same fund. Thus, the cost price of your equity fund is readjusted to 5.6 lakh. At the end of 2 years, this 5.6 lakh would have grown to 6.27 lakh, assuming a 12% returns. With respect to the cost price of 5.6 lakh, your gains would be about 67,000. Again, you sell the equity fund and realize your profits of 67,000. Since this amount is less than 1 lakh, it again attracts no tax. Now you invest the proceeds of about 6.27 lakh in the same fund. Your cost price is again reset due to this. You keep doing this until year 10. From the year 6 onwards, as the profit goes beyond 1 lakh, you will have to start paying some tax. But if you add up the tax from year 6 to 10, the total amount comes to be about 17,000. That's far less than the 95,000 you would have paid had you sold only in year 10. And that's the magic of tax harvesting. It can significantly reduce the tax outgo on your long-term capital gains. That's why tax harvesting is also called tax gain harvesting. Do note I said long-term capital gains. Tax harvesting is applicable only on long-term capital gains and not short-term capital gains. And that's so because through it, we are trying to put the tax exempt limit of 1 lakh to our advantage. Now, many of us invest in equity funds through SIPs. That's good as SIPs help you average your investment cost. But how does tax harvesting work in the case of SIPs? For that, you will have to consider those SIP tranches that have completed at least a year. So if you pay 12 monthly installments in a year, in the 13th month, the first installment would have completed 1 year and is eligible for tax harvesting, provided you have a net gain. In other words, the SIP tranche that's invested first is redeemed first. That is also called FIFO or first in, first out. But you will have to ensure that your respective SIP tranche is in profit. That is, the current NAV is more the NAV at which you made the SIP investment. If that's not so, you will actually be making a loss on the SIP and won't be doing tax harvesting as such. Now, another question that arises here is whether doing this breaks compounding. After all, you are regularly redeeming the units of your fund. The good news is that tax harvesting has no impact on compounding, provided you keep investing the proceeds back into the fund. That's because through tax harvesting, all you're doing is resetting your cost price and converting unrealized gains into realized gains. You aren't withdrawing any money as such, so compounding is not hindered. So this was tax harvesting or tax gain harvesting. Its close pair is tax loss harvesting. Let's see it now. But before we go there, let me request you to subscribe to this channel if you aren't already a subscriber. And please don't forget to click on the bell icon so you never miss a video from us. Okay, so when you have long-term gains, you can reduce your tax outgo by tax gain harvesting. But losses in your portfolio can also help. They can actually be more useful. How? That's because tax gain harvesting works for long-term capital gains only, but tax loss harvesting works for both short-term and long-term losses on equity. Let's say you have two equity funds, A and B. You invested 1 lakh in both of them, say 6 months ago. Now after 6 months, the investment in fund A fell to 80,000 while that in fund B rose to 1,20,000. At this point, you decided to sell fund B and pocket gains of 20,000. You continue to hold fund A since you still find it worthy of your investment. Since you sold an equity fund within 1 year of buying, you would have to pay STCG tax at 15% of the gains. That's 3,000 rupees. Now, tax loss harvesting can help you save this tax. Let's see how. Now, if you also sell your loss-making fund, you will make a loss of 20,000. This loss will be set off against your gains of 20,000 from fund B. As a result, you will have to pay no taxes at all. Then you invest 80,000 you got from fund A back into fund A. Now, you might say by doing so, you were actually made to book losses on a worthy investment. What's the point in doing that? So here's the logic. When you sell off and then buy back the loss-making fund A, nothing changes for you. You have had 80,000 invested in it and you will still have 80,000 invested in it. The only change that happens is that your unrealized losses have been realized and as a result, the cost price of the fund has been reset. But doing so helps you save tax. And that's the concept of tax loss harvesting. So in tax loss harvesting, you actually reduce or nullify your tax by deliberately booking losses that can be set off against the gains. The same thing can be done with the long-term capital losses as well. But here, in the case of equity funds, tax will be applicable on gains beyond the 1 lakh rupees. An important thing here, you can set off your long-term capital gains only against long-term capital losses. On the other hand, short-term capital gains can be set off against both short-term and long-term capital losses. Another important thing, tax laws don't differentiate between asset classes when it comes to adjustment of short-term and long-term gains. So gains and losses originating from equity, debt, real estate and even commodities can all be set off against each other. Now this makes tax loss harvesting a much broader concept with a lot of maneuver. And yet another important thing, you can carry forward your losses up to 8 financial years. So even if tax loss harvesting results in a net loss at the portfolio level, those losses can be carried forward and adjusted against future gains. thus helping you lower or eliminate the tax in the future as well. You can even use tax loss harvesting as a means to clean up your portfolio. So if you have loss-making investments in your portfolio that you have identified as mistakes, you can get rid of them. Of course, you won't buy them back with the proceeds, rather you will deploy the money in better investments. But doing so will help you adjust the losses from them against the other gains in your portfolio. This reduction in the tax to be paid will act as a compensation for the cleaning up for your portfolio. And if you adjust the amount saved in tax against losses made, the losses will also be comparatively lower. So these are the concepts of tax gain harvesting and tax loss harvesting. But there are some practical considerations that you must be aware of. Let's see them next. Okay, so this is going to be a list of things. The first one is calculating your capital gains. If you want to apply tax harvesting or tax loss harvesting, you should know your outstanding capital gains, right? Well, based on them, you can decide how much more tax harvesting you need to do or how much tax loss harvesting can help. If you have been maintaining an active record of your transactions, then this shouldn't be a problem. But if you don't have a ready record, capital gain statements from mutual fund KRAs, CAMs and K-Fintech can help. Alternatively, you can get them from the fund houses where you have invested, and you can also find them on the ET Money app. All you need to do is map your external portfolio onto the ET Money app, and we take care of number crunching for you. And if you are a stock investor, you can get the capital gain statement of your stock transactions from your broker. Some platforms also have tax harvesting and tax loss harvesting tools that can automatically help you use them. Though all these tools are available, I would still suggest that you maintain a record of all your transactions and keep an active eye on your capital gains. That will make things a lot easier when it comes to tax harvesting and tax loss harvesting. Now, one thing to be noted here is that tax exempt limit of 1 lakh on long-term capital gains is the overall limit, includes equity funds and stocks too. So if you have invested in both, do take into account this fact. This brings us to the next point. Remember what I said when I told you the process of tax harvesting and tax loss harvesting. You will have to buy back the same fund instantly. Now, mostly proceeds from the funds sold won't be available instantly, so you must maintain enough liquidity. Actually, this is also a hindrance. Many of us may simply not have the required money in the bank account. If you buy back after a day or two when the sales proceeds have been credited to your account, you risk a jump in the NAV. If the NAV has increased and you are buying back at a higher price, the benefit of tax harvesting will be reduced. But there is a way out. Rather than doing tax harvesting and tax loss harvesting at the FI end, you should do it through the year in tranches. That will preclude the need for a large liquid amount to a great extent. Just keep an active eye on the capital gains in your portfolio throughout the year. Let's now talk about the third factor. Selling funds or stocks can entail costs. This can reduce the benefits from tax harvesting and tax loss harvesting. In the case of funds, there could be an exit load, and in case of stocks, there is the brokerage and other related costs. While in the case of stocks, you may not be able to avoid the brokerage. In the case of funds, you can carefully pick funds that don't have an exit load. But the story doesn't end here. If your fund has restricted inflows or accepts only SIP, tax harvesting or tax loss harvesting may not be possible. It's not possible in ELSS funds as you can't sell it before the 3-year lock-in period. So all these complications are there. Let's see the next point now. Tax loss harvesting can be a really tempting proposition. You can lower your taxable gains with its help, and you can even book a net loss for a financial year. This loss can be carried forward for up to 8 financial years. So one may be tempted to overdo it, thus accumulate losses over the years. That may shift the focus on tax saving from wealth creation and result in needless activity that keeps making your broker richer. So it's important to stay rational and reasonable. Keep in mind that wealth should set you free rather than keep you endlessly occupied. And finally, the last point, and perhaps the most important one. Okay, just because an avenue of tax saving exists doesn't automatically mean that you have to go for it. For very many investors, tax harvesting and tax loss harvesting may appear to be confusing and nothing less than a recurring headache. If that's the case, feel free to give it a miss and focus on wealth creation alone. As Benjamin Franklin said, nothing is certain except death and taxes. So there's only so much you can do to save taxes. By accepting this reality, you can shift focus to wealth creation from tax saving, and that's desirable too. So ask yourself whether you would like to use tax harvesting and tax loss harvesting to your advantage. If you're not too sure, do it in a small way and then scale it up over the years. The idea is not to lose control of your portfolio. And if you realize they aren't meant for you, it's perfectly fine. And this brings us to the end of this video. Hope you found it useful. And if you did, please share it with your friends and family. I'll be back with another video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.